It began quietly, not with an announcement, not with a press conference, not even with a headline. It began with unanswered emails, delayed confirmations, and polite apologies that carried an unfamiliar finality. As this is being recorded in early January 2026, procurement desks across 3 continents are seeing the same pattern emerge. Orders that, for years, moved through the global system almost automatically, are no longer moving at all. Purchase agreements that were once routine are now being declined without negotiation. Long-standing supply relationships are being paused indefinitely. There is no panic in the language of the messages. No alarmist wording. Just a repeated phrase that keeps appearing in different forms, from different companies, in different countries. Unable to proceed under current export regulations. For most viewers, this may sound like another instance of trade friction, another bureaucratic delay that will be resolved with time. But for the industries involved, it is immediately obvious that this is something else entirely. What has changed is not demand. Demand for silver has not collapsed. In fact, it has been rising steadily for years. What has changed is access. On January 1, 2026, a new export licensing regime governing refined silver shipments out of China became operational. This was not a new policy announcement. It was not unexpected. The framework had been discussed publicly more than a year earlier. But until that moment, many outside observers assumed it would function like countless other trade rules, before it inconsistently applied, selectively enforced, and quietly navigated. That assumption is now gone. Within hours of the policy taking effect, shipments were halted. Customs approvals were denied. Contracts were cancelled. Deposits were refunded. And for the first time in decades, a central artery of the global silver market went completely still. To understand why this matters, it's important to clarify something that is often misunderstood. China is not the world's largest silver miner. That distinction belongs to countries like Mexico and Peru. What China dominates is not extraction, but transformation. Over the past 30 years, China built the largest silver refining ecosystem on the planet. Smelters, purification facilities, chemical processing plants, logistics hubs, and technical expertise were developed at a scale no other country attempted. As a result, the majority of silver mined globally does not become usable metal until it passes through Chinese infrastructure. For decades, this arrangement benefited everyone. Mining countries had a reliable destination for their output. Manufacturers had access to large volumes of refined silver at predictable prices. China earned margins on processing and embedded itself deeper into global supply chains. That era has now ended. The new export system does not simply require paperwork. It imposes structural thresholds that most refiners cannot meet. Minimum annual production levels, significant capital requirements, government oversight of individual shipments, and critically, discretionary approval authority that allows exports to be delayed or denied without explanation. In practice, this means that many private and mid-sized refiners are entirely excluded from exporting silver, and even large, state-affiliated firms that qualify on paper now require case-by-case authorization for every shipment leaving the country. The immediate effect is not theoretical, it is measurable. Manufacturers in North America and Europe that rely on steady quarterly deliveries are discovering that their Chinese suppliers, some of whom they have worked with for over a decade, are no longer legally permitted to ship. Alternative suppliers are being contacted. Most are already fully booked. What is unfolding is not a price spike yet. It is a logistics failure. Silver is unusual among commodities because it sits at the intersection of finance and manufacturing. It is both a monetary metal and an industrial input. When oil becomes scarce, prices rise but supply still flows. When semiconductors are scarce, factories slow. Silver shortages do both simultaneously. The modern economy uses silver everywhere. In power electronics, in solar cells, in vehicle control systems, in data centers, in medical equipment, in aerospace components. It is not easily substituted without performance loss, cost increases, or design changes that take years to implement. Most manufacturers operate on lean inventories. They do not stockpile metals for long periods. When supply is interrupted, production planning becomes reactive almost immediately. What makes the current situation especially fragile is timing. This policy did not arrive during a period of excess inventory or market slack. It arrived at a moment when Western silver stockpiles were already declining. Exchange-registered inventories had been falling steadily throughout 2025. Dealer availability was thinning. Delivery times were extending. In other words, there was no buffer. When Chinese exports slowed, there was no alternative reservoir ready to compensate. Non-Chinese refiners are already operating near full capacity. Most of their output is locked into long-term agreements signed years ago. The amount of uncommitted refined silver available globally is far smaller than most observers realize. This is why the reaction among procurement professionals has been so uniform. The issue is not price negotiation. It is physical availability. The phrase being repeated internally is allocation risk. When materials become scarce, supply is not distributed by market efficiency alone. It is allocated by governments, by strategic priorities, by political considerations. And that is the deeper shift taking place. This export regime is not simply about conserving resources. It reflects a broader strategy that China has been implementing across multiple critical materials. Control the processing, control the flow, and by controlling the flow, influence where manufacturing occurs. If refined silver is readily available inside China, but difficult to obtain outside it, then companies face a choice: relocate production closer to supply, or compete for shrinking external allocations. This is not hypothetical. It is already influencing boardroom discussions. Factories cannot run on financial instruments. They require physical inputs, delivered on time, at scale. When those inputs are uncertain, investment decisions change. In the coming weeks, more details will surface. More contracts will quietly expire without renewal. More companies will disclose supply disruptions in earnings calls. The story will gradually move from procurement departments to financial media. But by the time it becomes a headline, the underlying shift will already be locked in. This is not the beginning of a crisis. It is the moment it becomes visible. And what follows next will not be driven by speculation, but by necessity. What happens next is not dramatic in the way movies portray crises. There are no sudden announcements, no flashing red alerts on television screens. Instead, pressure builds quietly inside systems that were never designed to absorb a shock of this magnitude. The first place that pressure becomes visible is not on factory floors, but inside the mechanisms that exist to smooth supply disruptions. Commodity exchanges, bullion banks, and inventory vaults that normally function in the background of the global economy. For decades, these systems worked because they were rarely tested all at once. Silver supply disruptions were usually regional. Demand spikes were usually sector-specific. When one area tightened, another loosened. When one buyer panicked, others stepped back. Balance was maintained not by abundance, but by diversity of access. That balance is now gone. When Chinese refined silver stopped flowing outward, industrial buyers did not immediately rush into headlines. They did something far more consequential. They began activating their last remaining contingency plans. Those plans almost always point to the same place: the futures and bullion delivery system. On paper, commodity exchanges exist to manage price discovery and risk. In practice, for industrial users, they are the backstop of last resort, the place you go when normal suppliers cannot deliver physical material on time. But this system was never designed to replace primary global refining capacity. Exchange-registered silver inventories represent a fraction of annual industrial demand. They are meant to facilitate settlement, not absorb mass physical withdrawals by manufacturers whose upstream supply has vanished. As Chinese exports shut down, procurement teams began quietly securing delivery rights wherever they could. Not because they wanted to speculate, but because they needed metal in hand. This distinction matters. Speculative demand is flexible. It exits when prices rise or margins compress. Industrial demand is inflexible. A factory either receives inputs or it stops operating. When the choice is between paying a premium or halting production, price becomes secondary. That is when market structure begins to break. As more buyers turn toward exchange delivery mechanisms, registered inventories start declining faster than usual. Not catastrophically at first. Gradually, consistently. Each withdrawal justified. Each delivery rationale on its own. But the aggregate effect is cumulative. Vaults are not replenished quickly. They depend on refined supply arriving from the same global system that is now constrained. When outflows exceed inflows for long enough, availability tightens regardless of quoted prices. This is where the disconnect between paper markets and physical reality emerges. On a trading screen, silver may still appear liquid. Contracts change hands. Volumes remain high. Prices fluctuate. But underneath that activity, the quantity of metal that can actually be delivered is shrinking. This creates a subtle but powerful distortion. Paper prices reflect expectations and leverage. Physical prices reflect scarcity and logistics. When those two diverge, confidence erodes. Dealers see it first. Retail distributors, who rely on consistent wholesale supply, begin experiencing delays. Orders that once took weeks now require months. Allocation limits are imposed quietly. Then inventories begin disappearing altogether. Premiums rise not because sellers are greedy, but because replacement cost becomes unknowable. When you don't know if you'll be able to restock, you price accordingly, or you stop selling. This is why shortages often feel sudden to the public, even though they've been developing for months. By the time retail buyers notice empty shelves, upstream systems are already strained beyond recovery. But the more significant stress does not come from retail demand. It comes from competition between industries. Silver is not used evenly across sectors. Some applications consume tiny amounts, but cannot function without it. Others use large volumes and have no economically viable substitute. When supply tightens, allocation becomes implicit. Manufacturers that produce high-margin or strategically sensitive goods are willing and often able to pay more. Others cannot. This creates a hierarchy of access that has nothing to do with market fairness and everything to do with leverage. Defense contractors, medical device manufacturers, and critical infrastructure suppliers begin securing preferential treatment. Automotive firms follow. Renewable energy manufacturers compete aggressively. Smaller electronics producers fall behind. This is not speculation. It is how every constrained resource behaves under stress. What makes silver unique is that its refining bottleneck magnifies these effects. Mining output cannot respond quickly. Most silver is produced as a byproduct of other metals. You cannot simply turn on more silver production without also increasing copper, lead, or zinc output, which depends on entirely different demand cycles. Recycling helps, but it is incremental. It cannot replace hundreds of millions of ounces on short notice. And building new refining capacity takes years, not quarters. So when Chinese refining output becomes domestically absorbed rather than globally distributed, the loss is structural, not cyclical. This is why the idea that other countries can simply step in misses the point. Existing non-Chinese refiners are already operating near maximum utilization. Their supply chains are contracted years in advance. They cannot suddenly reallocate output without breaking agreements that underpin their own financial stability. Even if every available ounce of uncommitted refined silver outside China were redirected, it would cover only a fraction of the demand displaced by the export restrictions. This is where financial institutions enter the picture. Bullion banks, which intermediate between producers, exchanges, and industrial users, are suddenly exposed to delivery risk. Their business models rely on predictable flows. When those flows become uncertain, risk management shifts rapidly. Margins are raised, contract terms tighten, physical settlement becomes more selective. From the outside, this looks like market volatility. From the inside, it is defensive behavior. No institution wants to be the one left holding a promise when the metal itself is unavailable. And then there is the geopolitical layer. Countries that still have access to stable silver supply gain an advantage that is not immediately visible in GDP figures, but becomes apparent in manufacturing continuity. Chinese manufacturers, operating within the domestic refining ecosystem, do not face the same uncertainty. Their supply is allocated, prioritized, and coordinated in alignment with national objectives. Western manufacturers, by contrast, must compete for residual availability across fragmented markets. This asymmetry reshapes competitive dynamics without a single tariff being imposed. It also limits political response options. Export restrictions on finished goods do not create silver. Sanctions do not refine metal. Strategic reserves, where they exist, are small relative to industrial demand and are politically difficult to deploy for commercial use. What remains is adaptation under pressure. Companies delay expansion. Product launches slip. Capital expenditures are reassessed. Some production is relocated. Some is paused. These decisions ripple outward. Suppliers adjust forecasts. Logistics firms reduce volume expectations. Labor plans change. Financial projections are revised downward. This is how a materials constraint becomes a macroeconomic event, not through collapse, but through friction. Growth slows, not because demand disappears, but because supply cannot support it. And because silver sits inside so many modern technologies, the slowdown does not stay contained within one sector. It spreads horizontally. The market has not fully priced this yet. It cannot, because pricing assumes optionality, the idea that alternatives exist. But alternatives require time. What the current moment represents is not the peak of the issue, but the transition from abstraction to reality. The systems designed to absorb shocks are now absorbing one they cannot offset. And once that realization becomes widespread, behavior changes. When supply disruptions are temporary, markets adjust. When they are structural, systems evolve. What is now becoming clear to policymakers, corporate planners, and central banks is that the current silver constraint does not fit the pattern of a short-term imbalance. It is not the result of a natural disaster, a labor strike, or a single regulatory dispute that can be resolved quietly. It reflects a deliberate reconfiguration of control over a critical industrial input. And once control becomes centralized, behavior changes permanently. The most important shift is psychological rather than numerical. For decades, global manufacturing operated on the assumption that refined materials, once extracted, would remain accessible through markets governed largely by price. That assumption no longer holds. Access is now conditional, and conditions are shaped by national strategy rather than commercial efficiency. This alters how risk is assessed at the highest levels. In boardrooms, the question is no longer simply how much silver costs. It is whether it can be obtained at all, and under what political circumstances. That distinction transforms procurement from a logistical function into a strategic one. As a result, companies begin acting defensively. They pursue vertical integration, acquiring stakes in mining firms or entering long-term offtake agreements that reduce exposure to spot markets. They invest in recycling not because it is cheaper, but because it is controllable. They build inventories where possible, even at high cost, because predictability becomes more valuable than efficiency. None of these responses increase near-term supply. In fact, they often reduce liquidity further by removing metal from circulation. This is how scarcity feeds on itself, without a single speculator involved. Governments observe these shifts and draw their own conclusions. Strategic materials planning, once a niche concern, moves to the center of industrial policy. Defense agencies assess vulnerabilities. Energy planners reconsider timelines. Infrastructure projects are reevaluated based on materials availability, rather than financing alone. In this environment, countries that control processing gain leverage disproportionate to their share of raw resources. China's position is not simply that of a supplier, it is that of a gatekeeper. By concentrating refining capacity and tying export flows to discretionary approval, it has transformed a globally traded metal into a domestically allocated asset. This does not require confrontation, it requires patience. The leverage emerges not through denial, but through preference. Domestic manufacturers receive consistent access. Foreign buyers face uncertainty. Over time, investment follows certainty. Factories are not moved because of ideology. They are moved because inputs arrive on time. This is why the current situation is being watched so closely by multinational firms. Relocation decisions made under supply stress tend to persist long after the stress itself fades. Once capital is deployed, supply chains rewire. Reversing those choices takes decades, not years. This is how industrial geography changes quietly. Financial markets respond more slowly. Equity valuations adjust as earnings forecasts are revised. Some sectors outperform, others lag. Commodity-linked assets attract attention, not because of speculation, but because they represent tangible claims on constrained resources. Meanwhile, paper markets face an uncomfortable reckoning. When physical availability tightens, instruments that rely on the assumption of easy settlement become harder to price. Trust becomes as important as liquidity. Investors begin differentiating between exposure that represents optional delivery and exposure that represents actual metal. This distinction matters most when stress peaks. History shows that in such moments, financial authorities prioritize stability over purity. Settlement terms change. Incentives are offered. Time is bought. But no amount of liquidity creation can refine metal that does not exist. This is the boundary monetary policy cannot cross. The broader economic consequences unfold gradually. Production delays compound. Supply chains elongate. Inflation becomes uneven, concentrated in sectors tied to constrained inputs. Employment impacts follow not because demand collapses, but because production cannot scale. This produces a familiar but often misunderstood condition, stagnation alongside rising prices. It is not caused by overheating, it is caused by friction. As this environment persists, political narratives harden. Resource security becomes a domestic issue. Trade policy becomes more defensive. Strategic autonomy becomes a goal rather than a slogan. What began as an export licensing adjustment becomes a reference point in policy debates far beyond metals. And yet, this is not an apocalyptic scenario. Systems adapt. Innovation responds to constraint. Substitution accelerates where possible. Recycling improves. New capacity is built, slowly, but adaptation has a timeline. The next few years will be defined by competition for what already exists, not by abundance created overnight. Those who plan for continuity will fare better than those who assumed permanence. The significance of the current moment lies not in price charts or headlines, but in alignment. When supply, policy, and geopolitics move in the same direction, reversals become difficult. Silver is simply the visible indicator. What it reveals is a world transitioning away from the assumption that globalization guarantees access, toward a reality where access is negotiated, conditional, and increasingly strategic. This transition will not be announced. It will be felt. In quieter earnings calls, in delayed product launches, in revised forecasts, in factories built where materials are secure rather than where labor is cheapest. By the time the narrative becomes obvious, the structural changes will already be in place. This is how power shifts in the modern economy, not through sudden collapse, but through incremental realignment. And in that sense, the story unfolding now is not about a shortage. It is about who controls the foundations of production in the decades ahead.